That's a very good point. What we have seen is, initially pollution levels have dropped by about 60 to 70% in cities which have been affected by the coronavirus. In terms of what companies are doing, companies are conserving cash. Our thinking is that yes, there will be a pullback potentially in investment in renewables this year, but there are two other things which are a lot more sort of positive. One is companies have made commitments to the community, to their shareholders around reducing emissions. And we think companies will stick by those commitments. Secondly, and probably equally importantly, is there's two pieces of regulation which come into play this year, which drive that carbon efficiency. One is something called TCFD, and companies around Asia Pac and globally have signed up to TCFD requirements, which come into bear this year, which means companies need to meet their disclosure requirements and their carbon emission cut requirements. Secondly, the central banks around the world, and there's about 35 of these, are stress testing the financial system around climate risk. And those stress tests haven't been walked away from. So we still think there'll be pressure to continue to meet these climate change commitments, potentially less investment from government, but corporates we think will continue to spend up on climate change. We haven't heard of too many companies pulling back climate-related capex at this stage. Yeah, look, there's been some pressure brought to bear on companies, and I think companies have volunteered in many aspects to curtail dividends. Some have cut, some have pulled back on dividends. Almost, most companies have now stopped share buybacks. In terms of how do we look at sectors, probably there's a couple of things to say here. One, ESG as a universe has outperformed in the first few months of this year. If you look at from the peak of Feb to the end of March, stocks that are top ranked from an ESG perspective have outperformed the S&P 500 by about 5 percentage points. If you look at it at a sector by sector level as well, what we're seeing is that companies that have a high ESG score, so above median ESG scores, these companies are seeing less earnings downgrades. They're seeing much lower earnings downgrades. And that is most prevalent in consumer discretionary, in tech, in real estate, and in utilities. So what we're saying to investors is, dive under the covers, look at what's going on with these companies, and the companies that are better ESG companies are experiencing lower downward earning revision, which is a positive.